and welcome to Zensar Technologies Limited Q3FY25 earnings conference call hosted by Asian Market Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Shraddha Agarwal from Asian Market Securities. Thank you, and over to you, Ms. Shraddha.
Thank you, Manav. Good evening, everyone. On behalf of Asian Market Securities, I welcome you all to Zensar Technologies Q3FY25 earnings call. We have with us today from Zensar, Mr. Manish Tandon, CEO and Managing Director, Mr. Pulkit Bhandari, Chief Financial Officer, and a few other members of the senior management team. Before I hand over the call to Manish, I would like to highlight that the safe harbor statement of the second slide of the earnings presentation is assumed to be read and understood. Over to you, sir. Thank you.
Thank you, Shraddha. Hello, good morning, good afternoon, good evening, and a very happy new year to all of you on the call. Thank you for joining us today to discuss Zensar's financial results for the third quarter of FY25. I am pleased to also have members of my management team, Pulkit Bhandari, CFO, Vijay Sima, COO, and Vivek Ranjan, CHR. Despite Q3 being a soft seasonal quarter for the industry, I am pleased to share that we registered a year-over-year growth of 8.6% and sequential quarter-over-quarter growth of 0.5% in reported currency this quarter. This is one of the best Q3 performances that we as a company have produced in recent times. Our gross margins expanded by 200 basis points. Our order book stood at 205.3 million, which is the highest to date. We saw a net headcount addition of 277 associates this quarter with improved attrition. All-round performance across the key parameters reflects a strong business model, client centricity, operational excellence, and a people-first approach. Our ability to manage complex programs has helped us in building brand awareness and brought us closer to our customers. Verticalization and industry-specific solutions coupled with innovation have brought maturity into our solutioning and delivery. We have launched focused training programs to upskill our workforce, to enhance domain depth, and build next-generation AI skills. In Q3 FY25, the revenue stood at 157 million in reported terms, driven by a sequential quarter-on-quarter growth across all our geographies, with furlough-related slowdowns in a few pockets. In constant currency terms on a QOQ basis, our revenue in manufacturing and consumer services grew by a very healthy 6.5%. Healthcare saw a growth of 3.2%. Banking and financial services and telecom, media and technology witnessed a decline of 1.3% and 3.5% respectively, primarily due to furloughs. With that, I will now invite Pulkit Bhandari, our Chief Financial Officer, to provide an update on critical financial data.
Thank you, Manish. Good day, everyone, and Happy New Year. Thank you for joining this call. In addition to Manish talking about business, I will take you through some of the key financial metrics for quarter ending December 24. The reported revenue for the third quarter of financial year 25 stood at $157 million in dollar terms, reflecting growth of 0.5% sequentially despite furloughs and shutdowns in few of our customers. On a year-on-year basis, revenue grew by 8.6% in reported terms. In constant currency terms, revenue for the quarter grew by 0.7% sequentially and 7.5% year-on-year basis. Gross margin for the quarter stood at 30.1%, increase of 200 basis points quarter-on-quarter. The increase was primarily attributable to improved utilization, net of furlough impact of 0.1%, higher leave utilization of 0.9%, other operational efficiencies of 0.8%, including PPC benefit and other improvements. Exchange benefit of 0.1% also came into this. SG&A has increased by 180 bps Q on Q, primarily on account of one-time saving of ESOP and sales commission as called out in the previous quarter, and investment in sales and infrastructure. We exited Q3 FY25 at EBITDA of 15.6%, improved by 20 basis points quarter on quarter, which is in line with our guided range of mid-teens. Our PAT stood at 12%. Order book for the quarter stood at 205.3 million, which is the highest order book we have ever recorded. Maintaining our healthy cash generations, cash and cash equivalents stood at $269.2 million. And on back of strong collection, DSO improved by 3 days to 68 days. Some other key highlights: we unveiled a purpose statement. Together we shape experiences for better futures, which has resonated well with our employees and customers. Based on our farming efforts, one of our customers has moved into $20 million bucket. Our voluntary attrition stood at 10%, which has been lowest in recent years. MCS has grown for 6 quarters out of 7 quarters and has been continuously growing for last 3 quarters. BFSI continues to do well despite furlough impact in Q3 FY25, having grown 7 out of last 8 quarters. Our client concentration continues to improve, with top 5 customers contributing 27.5%. The Board of Directors have approved an interim dividend of rupees 2 per share for financial year 2025, which is 100% of face value. Our EcoVadis score improved from 52 to 66, with an impressive percentile increase from 53rd to 84th percentile now. We are pleased to confirm that our GHG net zero and near-term targets submitted to SBTi is approved. This endorsement reaffirms our commitment towards reduced environmental impact aligned with global goals on climate change. In line with our renewable energy goal of 50% by end of FY25, we are set to achieve our targets and initiated additional solar project in Pune campus, which is nearing completion. With that, I will now invite Vijay, our Chief Operating Officer, to comment further on Q3 FY25 results.
Thank you, Manish and Pulkit. Greetings, everyone. I will share details about our operational efficacy, service line performance, and AI capability initiatives. On the operational efficiency front, we are continuing our journey and making good progress on key imperatives. Our utilization increased by 220 basis points year on year and by 10 basis points quarter on quarter, despite Q3 being a seasonally low utilization quarter due to extensive furloughs. The rigor associated with accelerated fulfillment and capability enrichment continued in Q3. We had a gross addition of 975 employees in the quarter and a net addition of 277 people. Our voluntary attrition reduced to 10%, which is a 10 basis point reduction sequentially and a YOY reduction of 200 basis points. The service line offerings and industry services groups continue to resonate well with our clients. The share of revenue from our service lines, that is advanced engineering services, data engineering and analytics, experience services, and cloud infrastructure and security services, increased to 54.5% in Q3 of FY25, which is 60 basis points higher sequentially. On a quarter-on-quarter basis, in reported terms, advanced engineering services grew by 7.1%, cloud infrastructure and security services grew by 1.8%, application services and enterprise applications saw a marginal decline of 0.7%, experience services revenue dipped by 3.8%, data engineering analytics saw a decline of 4%, primarily on account of extended furloughs in specific accounts. AI capability enrichment journey continued. In Q3, our innovative AI offerings have delivered value to our clients by leveraging our 4 major AI solution stacks, namely enterprise AI solutions, responsible AI solutions, enterprise cognitive hyperautomation solutions, and multimodal micro-vertical solutions. A few key examples of value delivered to clients are as follows. We built Gen AI engine for modernization. Using this for a travel and leisure client, the engine automatically traversed millions of lines of legacy code and generated code in new age architecture, which was 40% more maintainable. We have built a client risk assessment assistant for a private bank, which creates a unified customer 360 view from various data sources. We have also built a GenAI application which helps business users to use natural language to interact with their data and get insights. With that, I now hand it back to Manish.
Thank you, Vijay. We are seeing some early signs of improvement in discretionary spending based on our conversations with clients and order booking, despite the ongoing macroeconomic uncertainties. Our purpose statement, "Together we shape experiences for better futures," has resonated very well with our clients and Zensarians alike. I am confident that we are well positioned to navigate the industry challenges. With that, we can open the lines for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. I repeat, you may press star and one to ask questions. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have our first question from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi, good evening. Congrats for another solid quarter. In the last quarter, you had mentioned two potential large deals in the pipeline. I just wanted your thoughts. Have any wins, losses there? Are they there in the TCV this time? And the second is, how does the pipeline look post these wins? Right. So those are the two things on that. And another ancillary question is that considering next quarter you should see a reversal in furloughs, do you think we will begin to see broad-based growth from here on? So that's the third. Yeah.
So thanks, Nitin. And it's the team that has done really well, delivered really well. Some of these drugs and healthcare. The new administration is supposed to be much stricter on healthcare costs, and hence healthcare companies are also going a bit easy on their spending. So I would say that the companies are right in saying that the healthcare life sciences spending is a bit muted as compared to what it normally is at this time of the year.
Got it. And sir, the last question from my end, we are already at an 8% YOY run rate in terms of YOY growth numbers. So are we confident enough to say that double-digit growth is a doable number for us in FY26?
It is 8.6%, and one lives up on hope. One takes up targets, and one tries to deliver on it. And we will try our best to deliver on double-digit growth next year.
Great, sir. Great to hear that. Thank you, and all the best.
Thank you.
Thank you. A reminder to all participants, if you wish to ask any question, you may press star and one on your touch-tone telephone. We have our next question from the line of Girish Pai from BOB Capital Markets. Please go ahead.
Yeah, thanks for the opportunity. Manish, you said you've been in the industry for multiple decades. Can you just describe what is the intensity of discretionary spending you're seeing right now compared to, say, the pandemic high that we saw, or even pre-pandemic? Would it be like 30% of the intensity we saw during the pandemic, or any number you can throw about the intensity of discretionary spend?
So I think, discretionary spend, two things I would say. Don't compare it to the post-COVID boom. Okay. That was a boom that was unlikely. Like the pandemic was a once-in-a-century event. You should view it as a black swan event. So let's talk about pre-COVID. I think the second thing that discretionary spend is a function of is what is new in the market, because you can't keep unless until there is something new or something exciting happening in the space. The discretionary spend, what will you spend the money on, right? So I believe that if this generative AI takes off, then we are definitely going to see a boom in discretionary spending, because then there are not too many options left. But if that doesn't happen, then we'll go back to the old normal, which was the pre-COVID discretionary spend.
Okay. And where are we compared to the pre-COVID discretionary spend like? In terms of intensity?
Sorry, come again?
In terms of intensity, how are we compared to the pre-pandemic discretionary spend?
I think we are there. I think we are 75-80% there. I don't think that suddenly people are going to spend much more, or were spending much more on these things. But if generative AI really takes off, then the discretionary spend is going to increase.
Okay. There was some discussion around two potential large deals which could not close in the last quarter. Is there an issue with decision making around these deals?
Yeah, any large deal. I mean, I won't say that there is any issue with decision making per se. Our deals take time. Just the paperwork and documentation, you have to go through literally 500, 600, 1,000 pages in contracts. That itself takes time, and once you do it, then you have to go through the permissions and so on and so forth before you can announce it. So I wouldn't say that large deals there is anything in material that I see in change of decision timeline.
Okay. Last question is on the magic words Gen AI and agentic AI. You mentioned that Gen AI could potentially trigger greater discretionary spend. Why has it not taken off this far, or do you think it's just on the verge of kind of taking off? That's one. And agentic AI, do you think that's going to change IT services in a very material way? Could be volumes involved in the business change? If you can throw some light on that.
No, it's a new technology. Everyone is excited about the technology. Everyone is experimenting with it. And new technology, not just that it's a new introduction. It's also new in terms of the robustness and capabilities of the underlying technology. I mean, it's like Windows version 1, right? So people are figuring out what is there, how can they improve it, and waiting for the next version of the technology to come. Agentic AI is really the next version. I mean, if you look at generative AI was almost entirely based on LLM, and then people realized that this LLM is just like an operating system, a platform. Unless until you build agents on top of it which can do specific tasks, this becomes a very moot point to have a platform. So think of generative AI as operating system and agentic AI like applications. And if you think of it that way, then you'll realize that without agentic AI, the popularity of generative AI is not going to increase, and adoption will not increase. So agentic AI is the way forward, yes.
And have you built capabilities around agentic AI?
Yes, we are doing some really exciting work on AI as a team. We are doing a lot of interesting programs. Maybe Vijay, can I request you to address this question?
Yeah, so look, I think as part of our, as I said, there are 4 solution stacks, right? And one of them is the multimodal micro-vertical AI solution stack. All of those are basically around the agentic AI kind of a stuff, leveraging various other AI models. So that's where we are finding a lot of traction. With your specific question about capability building, yes, because I think, look, from an agentic AI perspective, you need to have the technology capability as well as the domain capability to figure out how to basically orchestrate the various models to build the right agentic AI. And given our focus on ensuring that cross-functional teams from a technology as well as the domain team works, we are making good progress on that. And broader AI capability, we are really doing an extremely good job in terms of transforming our people by uplifting the AI capability across 5-6 levels of AI-based training. So we are confident that our AI solutions will offer differentiated value to our clients.
Okay, thank you very much.
Thank you. We have our next question from the line of Amit Chandra from HDFC Securities. Please go ahead.
Yes, sir. Thanks for the opportunity. So my question is on the strong TCV that we had for the last 2 quarters. So what on a proportion of the TCV you would ascribe to higher discretionary spends in the last quarter versus maybe a year back? How the increase in discretionary is helping us in terms of high TCV, and also in terms of the conversion of the current TCV to revenues. Because last year also we had very strong YY growth in terms of TCV, but it's not showing up in revenues. Maybe X of the top client, we are growing much higher. But in general, how we are seeing the conversion of the TCV to revenues, and also the component of AI-led deals, which is actually adding up to the TCV.
All right. So there are several questions. So first, let me first answer your question on conversion. The way we defined our order booking is not based on TCV or ACV. It is based on signed SOWs. So our order book to conversion is 100%, if not more. Actually, in some cases, 105%, because we go and get additional SOWs on that. So first of all, you should assume 100% conversion of our order booking, because the way we do it is signed SOWs. Second is your question on discretionary versus non-discretionary. Actually, we as a company, one of the reasons for our fluctuating fortunes, so to say, was that our services were focused too much on discretionary spends, and we were not doing enough annuity revenues. So actually, unlike others, we are trying to get more annuity revenues and more focused annuity revenues, so that that variability and the fluctuation in revenues can be avoided. And towards that, large deals is one of the ways in which we are trying to do. The other area where we see a lot of annuity revenues is in the cloud and infrastructure services space, and that has been growing well for us. Even this quarter, it grew sequentially 1.8% for us, which was very good. So I would say I don't have the exact numbers, but if I were to make a punt, then I would say if last year 80% of our order booking was discretionary, this year maybe 70% is discretionary, and we want it that way.
Okay. Secondly, on obviously it has been asked multiple times, but on the top client performance, especially the high tech, you said that we'll see some recovery in fourth quarter, but just to get a sense of how much of high tech is the top client, is it safe to assume that 50% of high tech would be still the top client?
So we don't give a split of the top client or any client specific split within the segment. But they
So the important data for you is that last year TMT sector was 27% of revenues. This quarter it is 21.4% of revenues. And as I said, right from the beginning, it has been our endeavor to make sure that whatever happens in TMT, the rest of the business grows much faster than that, and that's why you will see that despite TMT sector declining by 3.5% sequentially this quarter, our year-over-year revenue has grown 8.6%, and which is a testimony to the de-risking that we want to do of this sector.
Okay. And sir, lastly on the client buckets, it's encouraging to see that after multiple quarters we have added one client in the 20 million plus bucket. So obviously it's a function of efficient client mining and focus on more higher annuity. So if you can throw some more light on from which vertical this client is there, of which has entered the 20 million plus, and also some more clarity on how we are focusing on the mining part.
So first of all, this client is in MCS, Manufacturing and Consumer Services.
Ladies and gentlemen, please be patient while we reconnect the management. Ladies and gentlemen, thank you for patiently waiting. We have the management back with us. Over to you, sir.
Yeah, Amit, I don't know how much you heard, so I'll answer your question again. This client was in Manufacturing and Consumer Services vertical. This was in the 10 million range, and now it has graduated to 20 million range. Farming is, we continue to build the farming muscle of Zensar. That's one of the key things that, along with client centricity, that we are trying to build on. It is work in process. We have laid the foundation. we have to continue to build on it.
Okay, Manish. Thank you and all the best.
Thank you.
Thank you. We have a follow-up question from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi. Thank you for the follow-up. So in the last 2 years, I think when we began this journey, one of the focus areas was to increase the number of services sold per customer. Just wanted your thoughts on how this metric would have sort of improved since you took over. And the second is, in the last 2 years, would there have been meaningful client additions in the TMT vertical itself to help broad-base the client buckets there?
So, Nitin, I'm just trying to look at the data point. Our revenue from our service offerings beyond application development and maintenance has increased from 56% of our revenues are coming from services, from newer service offerings beyond the ADM space. Overall, this number was less than that by. Let me see. Just give me a minute. I'll answer that.
Or even a rough sense on maybe the top 10 customers, the number of services per customer, if that has improved, that will also be helpful.
Just give me a minute. Nitin, it has improved significantly. We'll come back to you. Okay.
Sure, absolutely. And diversification within TMT, would we have added a reasonable number of customers over the last 2 years within TMT?
Yes, we have diversified. In fact, this quarter we added one of the larger semiconductor companies in this space as our client. So we continue to add more newer clients in this space.
Would it be a meaningful number over a 2-year period?
Sorry?
Would it be a meaningful number in terms of client additions within TMT over a 2-year period?
I'll have to give you the exact number, but we have done a meaningful addition, yes.
Yes, sir. That's helpful. Thank you so much and all the very best.
And Nitin, the revenue from service lines is 51.4% this quarter, as against a baseline of 47.5% last year. So we are continuing to see increased intake of our service lines as compared to the legacy services that we are doing.
Sir, that's helpful. Thank you. All the very best.
Thank you. We have a follow-up question from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity again. Manish sir, just wanted to understand, when you enter FY26, you are already commented that things are improving